When you look at the Deutsche Bank story and the risk that it has induced onto markets last week, what rabbit hole did we just go down last week?
We went down a hole that really no one's been paying too much attention to over the course of the past, I would say, couple of years. We saw a little blip of it, obviously, back in February with the slight wobble around the cocos, and then it all went quiet as political risk. The market got very, very myopic about risks. We were worried about China, we were worried about Brexit, and everything else was let to kind of fester in the background. And this fine, a simple, I say a simple, huge fine hitting a bank, the possibility that it's likely to be revised lower, but just that little nudge of risk has been enough to send us drastically lower. So you have to say that sentiment, particularly in this sector, is very, very poor at the moment.
Jeremy, it's Anna here. So sentiment is poor in the sector. Does this stick to the euro at all? Can you see a way that it does?
We haven't seen too much reaction in certainly in the euro currency at the moment, and certainly, against sterling, for example, it's still looking very, very healthy on the Brexit risks on the pound. We have seen a little bit of a switch over in euro dollar and the funding, how it's being funded for carry trades elsewhere. It seems to be that in the early part of the year, the euro was the funding currency, and now we're seeing the dollar being used as the funding currency. So the correlation there has switched around. So the euro is still maintaining a very, very good backbone at the moment, and will likely do so, I think, until that ECB meeting in December of this year. So not an impact quite yet.
We'll get to the consequences of that carry trade a little bit later in the show. Let's talk about the impact for the ECB, because we have a pie chart. Let's just show you. I mean, this is the demolition job that Deutsche Bank has done. Now, a third of the sovereign debt is ineligible. 2.2 trillion euros worth of bonds yielding more than the deposit rate in terms of negatives. I'm getting lost in my positives and my negatives. This is another representation for you. This is the Bloomberg Barclays global aggregate going more negative, now nearly 12 trillion. We're rising by 6%. This is a real consequence for the markets, isn't it?
It is. And how do they turn it around with the central banks continuing to say we are going to go out and to continue to buy a set amount, a huge amount of debt on a month-by-month, quarterly basis, rolling out into the early part of next year, with with deposit rates still so low, with global aggregate demand not picking up.
Is this going to bounce Draghi into having to do something more aggressive?
I think it depends on how you characterise more aggressive. I don't think we see, for example, another cut in deposit rates. I think that we may see some form of erring around the edges around the capital key.